Good morning, this is Ken Long from Tortoise Capital Management with a review of the weekly reports for October 2nd, 2011. We have a market that's in bearish normal conditions. It's neutral on an annual basis at the very high end of oversold on a 10-day basis. Percent stretch above the 200-day moving average is at minus 10.84%, which is bearish. The slope of the 50-day moving average has further weakened to minus 1.44, which is, and both are coded red and noted as bearish. ADX has dropped under 20 for the first time in a while at 19.8. So we have a no trending condition, although the bearish price action is in charge. That's evidence of a sideways market for sure. ATR percentage increased this week to 2.72% at the high end of normal. The blended monthly rebalancings, current holdings, a double helping of treasuries and one position in the short-term treasuries. On the 13 ETF portfolio, it's all three positions in treasuries. You could also mix in some SHY if you don't want the volatility of TLT. ETF2 is all cash with the theoretical exposure at 0%, and the model portfolio also being at 0% exposed. We've completed Bundle 2 of the TradeStation project, and that's going to be available for members. That adds a half a dozen of my best market indicators and screening technologies, some technical analysis for you. Moving on. This is just a summary of the blended monthly rebalancing for the 13 and the 26 ETF portfolio. I won't dwell on that, other than just to observe nothing is above its 4-month moving average with the exception of TLT. Some of our members have been experimenting with the use of inverse funds in this model and have been holding positions in SH, which is the inverse S&P, and reporting good results. However, because not everybody has access to inverse funds, I've run in just the basic model. And in bearish markets, the positions in cash or treasuries protects you against capital loss. In the market health check, again, we have vertical blue lines are the 10, 20, and 30-day look-back periods. The solid purple line at 137 is the swing high that goes back into April. The dotted purple lines are resistance levels from various times in the past 6 months. The black line in the middle is the 30-day regression line. The slope is practically zero. The outside black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period, which occurred earlier in September here. You can see we're getting ready to test that bottom boundary. The solid red line is the previous swing low at 112, which is close to being tested again. You can see that that's been a support level consistently, but we're going to see if it happens again. Has not been able to break through this 122 price level on these recent swings, and you can see what we have here is a sideways market characterized by ADX less than 20 and with bearish activity in charge right now because red is over the blue, over the green, excuse me. We're at oversold conditions on Williams percent R10. You can see the percent price oscillator has rolled over and is now below the zero line, and the jaws are open to the downside, which is an indication of an opportunity to go short on a breakdown of let's say about 112. The slope of the regression line is hovering right on the zero line. You can see almost a perfect sideways market with lots of volatility on the short swings. ETF2 report is all cash. The two strongest sectors are the NASDAQ and Japan, and the two weakest are emerging markets in Latin America. Inside the U.S., it's the tech. It's better than large caps, better than mid caps, better than small caps. World market model, we have selected currencies are above average. The defensive sectors of staples, utilities, and healthcare are better than the rest of the business sectors. Gold, silver, and treasuries well above average. The U.S. is a mix. Large caps are leading mids and smalls. Asia is a mess. Europe is a mess. Only Japan, because of their stable, no-growth economy, are relatively better off. So a pretty gloomy forecast altogether. The 100 by 200 crossover system has buy signals in utilities and treasuries, and most everything else being short, based on longer-term technical characteristics of the 100 and 200-day moving averages. Top 30 from the ETF2 database, dominated by interest earning ETFs, gold and silver, precious metals, and that looks to be just about it. No equities appearing in there anywhere except for the utilities XLU. ETF top 30 based on liquidity, average daily dollar volumes. Silver has slid down to position number 12. Gold is in 4th position. Those that are highlighted in green are the ones that are exceptionally volatile intraday, and thus make good intraday trading targets because of the combination of liquidity and volatility. And that's the weekly strategy report. Keep your defensive team on the field. Take targeted shots on the short side and bounces on the long side. But we're still in a market in which a bird in the hand is worth two in the bush. I'm going to shift now to the daily report. And I'm not going to repeat the top row. In the gap stat, what we have is gap down and reverse to close higher is favorable right now. 8 times out of the last 30 days it has done that and averaged a follow through of 1.33. And then on gap ups, the reversal is also the favored play. 10 times out of 17 that it is gapped up, it has rolled over and closed lower. So that's almost a complete opposite of where we were a month ago at this time, in which going in the direction of the gap was the favored play. It's now gap down and reverse, and then gap up and fail are the big follow-throughs. The time series on the 10-day NDX shows we are in oversold conditions. No signals on overreaction or channeling. You can see the pivot points for reference. Volatility is at the very high end of normal. It won't take much. One more run of failure would boost us back up into volatile conditions. And you can see ADX is underneath 20 with the bears in charge. Only a couple patterns to note. Triple screen for Intel, channeling signals for gold, Coke, and Intel. The safe zone signal in the VIX. Stealth is in the defensive sectors like healthcare and staples, and then all of the consumer staples like Pfizer, Johnson & Johnson, Procter & Gamble, and Merck. Home Depot doing well on a relative basis. Longer term stealth candidates for modified French momentum at technology and IBM. 10-day max pain losers, in other words, the candidates for big bounces. If we get a one-day bounce, looking like a lot of the industrials and financials. So you get Alcoa, DuPont, Caterpillar, Bank of America, and American Express. Among the ETFs, it's silver, oil, service, minerals and mining, oil and exploration, oil and gas exploration, and then the gold majors, GDX. Looking at the tactical summary, you can see just how bad Alcoa and Bank of America have been in every time dimension. And then the winners tending to be down here in the green: Walmart, Procter & Gamble, Johnson & Johnson, Merck, and Verizon. Among the ETFs, big winners, Treasuries, and VIX, they've been so powerful that Nothing else even registers as exceptional. Exceptionally weak had been emerging markets, coal, and gold on the upside as well. One channeling signal in gold. Just for your quick reference, the frog list, you can see now that really from the middle of the yellow up, where the frog quality numbers are back above 3 and in some cases 4, meaning that there's been consistency in the daily ranges now, enough that where the frog strategy is now viable once more. Signal to noise ratio, seeing some more directionality here with it approaching 0.56 on signal to noise. So that's an indication we're having more directionality intraday. The fail stat, again, just for reference, we're examining how far on average it moves from the opening of the day to the low of the day to get an estimate of how to interpret potential turning points during the day. The market mosaic indicators, you can see a perfect sideways market here, and using the 30-day regression line, the slope is 0, the R squared is 0.004, meaning it's a pure sideways. You can see that it lost its way in the right about here 8 or 9 days ago. The improvement in the slope slowed down and now has gone basically flat, so the edge is gone. That was after a 1, 2, 3.5 standard deviation move from the peak of the sell-off, which you can see arrayed here with price relative to the 200-day moving average. We're still at a 2 standard deviation excursion below average, and in this case it's below the dotted red line, which is the 0 line. So we're still hovering on the edge of disaster. In other words, the disaster hasn't occurred yet. Intraday range percentages for your reference. Won't dwell on that. And holding the X-day, everything red in here, I'll hold that up there for your reference. I won't dwell on anything in there. In the quality report, what I look for is the divergences on 30-60-day quality. So candidates like Intel, United Technologies, and Merck stand out because of the degree of improvement between their 2-month ago quality score and the 1-month ago quality score. McDonald's still looks interesting to me. It's been one of the big leaders, as has IBM, and they're both above average. Among the ETFs, the standouts are Healthcare Select, XLV, and Industrials, which have actually found some support. Must be at the bottom of their business cycle because they're at least back to 0 after a really horrible 2-month ago period where their system quality number was minus 3.07. You can see just how far the mighty can fall with gold and silver that were in the green 2 months ago are now well below 0 on the 30-day quality score, and then how the losers can become winners. Healthcare and technology were below 0 and in the yellow 2 months ago and are now in the green, positive for 1 month. So I like to look for a change in state between the 2-month ago period and then an oscillation to strength. So the weak can become strong in a month and the strong can become weak in a month, and I want to try to catch those moves early in their life cycle. On the alpha stat, you can see the Dow and flight to quality has been gaining while the rest of the U.S. has been suffering. This is a 6 standard deviation move in the Dow from -3 to +3 in terms of cycling. And these sharp oscillations are typical of a sideways volatile market. Among the commodities, you can see oil, gold, and blended commodities all pointing back up. I own some gold, so I would like to see it continue to go here. And then among the internationals, it's Japan and flight to quality, and emerging markets in Latin America still below the 0 line. Just quick correlations for your reference, and that'll do it for the daily trading plan. Again, selected targets in defensive sectors, one-day shots on dead cat bounces, and piling on failures below yesterday's or the previous day's low is still the strategy for the week. And that's the Tortoise Capital Management Weekend Report Review. Good hunting.